You've probably heard about investing in stocks or index funds, but which one should you choose? That's our topic today. Should I buy individual stocks or index funds? Let's start with the basics. What are stocks and index funds? In the simplest terms, when you buy a stock, you're purchasing a small piece of ownership in a company. It's like owning a slice of the pie. You're betting on that company's future success and hoping that the value of your slice will grow over time. On the other hand, an index fund is a type of investment that tracks a specific market index, like the S&P 500. Instead of buying a single slice of pie, you're buying a little bit of all the pies in the bakery. This way, your investment is spread out over many different companies, reducing the risk that comes with putting all your eggs in one basket. So what's the main difference between these two? It boils down to risk and diversification. When you buy individual stocks, there's potential for high reward if the company does well. But there's also a higher risk, because your investment is tied to the success of a single company. On the flip side, with an index fund, your investment is spread across many companies. This diversification reduces the risk of losing money if one company doesn't perform well. However, the potential for high returns might be lower because you're not putting all your money on one potentially high-performing stock. In essence, choosing between stocks and index funds is a balancing act between risk and reward. It's about how much risk you're willing to take for a potential return on your investment. Now that you have a basic understanding of what stocks and index funds are, let's dive deeper into this subject. Let's start by exploring the advantages and disadvantages of buying individual stocks. Now you might wonder why anyone would choose to buy individual stocks when there are safer options like index funds available. Well, one of the primary reasons is the potential for high returns. When you invest in individual stocks, you can earn substantial profits if the company performs well. For instance, think about those who invested in Apple or Amazon in their early days. Their investments have grown exponentially over the years, turning a small sum into a fortune. So, the possibility of striking gold is definitely one allure of buying individual stocks. Another enticing aspect is the opportunity for direct control. When you buy individual stocks, you decide which companies to invest in, when to buy and when to sell. This allows you to build a portfolio that aligns with your personal beliefs, interests, and financial goals. If you're passionate about clean energy, for example, you might choose to invest in companies that are leaders in this field. But let's not forget, with great potential comes great risk. And that's one of the biggest drawbacks of buying individual stocks. The stock market can be unpredictable, and individual stocks are especially volatile. A company's stock price can drop significantly due to a variety of factors, such as poor earnings reports, negative press, or changes in the economy. And if that happens, you could lose a substantial portion or even all of your investment. Moreover, buying individual stocks requires time, effort, and knowledge. You need to research each company thoroughly, understand its financial health, analyze market trends, and keep a close eye on your investments. This can be overwhelming, especially for beginners or those with limited time. And then there's the issue of diversification. When you invest in individual stocks, it's challenging to achieve a diversified portfolio unless you have a large sum of money to invest. Investing all your money in a few stocks can be risky, as poor performance by one or two companies can significantly impact your entire portfolio. Lastly, the costs associated with buying and selling individual stocks can add up. Most brokerage firms charge a commission for each trade, which can eat into your profits, especially if you trade frequently. As you can see, there's a lot to consider when buying individual stocks. It's a strategy that offers the potential for high returns and direct control over your investments, but it also comes with significant risks and requires time, effort, and knowledge. And while the idea of striking it big with the next Apple or Amazon is enticing, remember that for every success story, there are many more companies that don't make it. So, make sure you're fully aware of the risks and ready to put in the necessary work before diving into the world of individual stocks. Now, let's shift our focus to index funds. What are the pros and cons of investing in these? First off, let's tackle the positives. One of the main advantages of index funds is their simplicity. With an index fund, you're buying a small piece of all the companies in a specific index. This could be the S&P 500, the Dow Jones, or any other index around the world. So, in one swift move, you're spreading your investment across hundreds or even thousands of companies. This is what we call diversification, and it's like the old saying goes, don't put all your eggs in one basket. Another advantage of index funds is their cost efficiency. Unlike actively managed funds where fund managers are constantly buying and selling stocks, index funds simply track an index. This passive management approach means lower transaction costs, and therefore lower fees for you, the investor. Now, onto the potential downsides of index funds. The first one that comes to mind is the lack of control. When you invest in an index fund, you're essentially handing over the reins to the index. You don't get to choose which companies you're investing in, and you can't avoid companies that you might not want to support. Another downside is the lack of potential for outstanding returns. Since index funds aim to mirror the performance of an index, they're not designed to outperform the market. So, while you're unlikely to significantly underperform the market, you're also not going to massively outperform it. Lastly, index funds can be subject to market volatility. Because they're designed to mimic the market, when the market drops, so does the value of your index fund. This is a risk inherent in all types of investing, but it's worth noting that with an index fund, you're exposed to the full brunt of market downturns. Now remember, every investment strategy comes with its own set of risks and rewards. Index funds offer a relatively simple, cost-effective way to diversify your portfolio. But they also come with a lack of control and the possibility of only average returns. As with any investment decision, it's important to consider your own financial goals, risk tolerance, and investing timeline. Do your homework, consider your options, and if necessary, seek advice from a financial advisor. Index funds also have their own sets of considerations. So, you've learned about individual stocks and index funds, but how do you decide which one is right for you? Choosing between investing in individual stocks and index funds isn't a decision to be taken lightly. It's a choice that hinges on several key factors, including your risk tolerance, investment goals, and the amount of time you're willing to dedicate to managing your portfolio. Let's start with risk tolerance. In a nutshell, your risk tolerance is your capacity to withstand losses in your investment portfolio without panicking. If the idea of your investments fluctuating in value on a daily basis makes you nervous, then individual stocks might not be suitable for you. Stocks are known for their volatility, meaning their prices can increase or decrease dramatically in a short period. On the other hand, index funds are generally considered to be less risky because they're diversified, spreading your investment across a wide range of stocks, which can help to smooth out the ups and downs. Next, let's talk about your investment goals. Are you investing for long-term growth, or are you hoping to generate income now? If you're aiming for long-term growth, index funds might be a good fit. They're designed to match the performance of a particular market index, providing steady, albeit sometimes slow, growth over time. On the flip side, if you're looking for the potential to generate more immediate income, you might consider individual stocks. But bear in mind, while the potential for high returns is there, so is the potential for significant losses. Finally, consider your time commitment. How much time are you willing and able to dedicate to managing your investments? Individual stocks require a substantial amount of time and effort to research and monitor. You'll need to keep up with company news, earnings reports, and market trends. If this sounds like more work than you're interested in, index funds might be the better choice. These funds are passively managed, meaning they require less time and effort on your part. Once you invest in an index fund, you can pretty much set it and forget it. Now, it's important to note that choosing between individual stocks and index funds doesn't have to be an either-or decision. It's entirely possible and often beneficial to have a mix of both in your portfolio. This approach allows you to take advantage of the potential high returns from individual stocks, while still enjoying the stability and simplicity of index funds. Ultimately, the decision between investing in individual stocks or index funds comes down to your personal circumstances, preferences, and goals. Take the time to evaluate what you want out of your investments, how much risk you're comfortable taking on, and how much time and effort you're willing to put into managing your portfolio. Remember, there's no one-size-fits-all answer. It ultimately depends on your personal situation and investment goals. We've covered a lot today, but there's one more crucial point to discuss. Let's not forget that the world of investing can be as vast and complex as the universe itself. It's filled with countless stars, galaxies, and black holes that can either propel you towards financial growth or pull you into a financial abyss. And just like exploring the cosmos, navigating the investment landscape requires knowledge, experience, and professional guidance. That's where financial advisors come in. These are the astrophysicists of the financial world. They have the expertise to guide you through the complexities of investing, whether it's deciding between individual stocks or index funds, or creating a diversified portfolio that aligns with your financial goals and risk tolerance. Now you might be thinking, I can just do my own research, right? Well, yes you can. There's an abundance of resources available online that can provide you with valuable insights about investing. However, remember that investing is not just about having the knowledge, it's also about applying this knowledge strategically. And that's where a financial advisor can add significant value. Financial advisors can provide you with personalized advice based on your specific financial situation. They can help you understand the potential risks and rewards of different investment options. They can assist you in making informed decisions that can potentially maximize your returns and minimize your risks. Moreover, financial advisors can help you stay disciplined and focused on your long-term financial goals. They can prevent you from making impulsive decisions that can jeopardize your financial future. They can provide you with the peace of mind, knowing that your investment strategy is in capable hands. So, whether you're a seasoned investor or just starting your investment journey, don't underestimate the value of professional financial advice. It can be the compass that guides you towards your financial North Star. And remember, there's no one-size-fits-all answer to the question, should I buy individual stocks or index funds? What's important is that your investment decisions align with your financial goals, risk tolerance, and investment horizon. Don't forget to consult with a financial advisor or do your own research before making any investment decisions. So, should you buy individual stocks or index funds? The answer isn't black and white, but hopefully, this video has given you some food for thought. We've delved into the world of individual stocks and index funds, weighing the pros and cons of each. Remember, individual stocks can offer high rewards, but they also come with high risks. Index funds, on the other hand, provide a safer, more diversified investment approach. Your decision should be based on your financial goals, risk tolerance, and investment knowledge. It's essential to do your own research or seek professional advice before making any investment. Remember, investing is not about quick wins. It's about building wealth over time. Thank you for watching. If you found this video helpful, please give it a thumbs up and don't forget to subscribe for more videos like this.